In this episode, I sit down with Mark Seed, founder of the popular personal finance site, My Own Advisor. Mark is on a journey to achieve financial freedom and is currently making over $40,000 a year in dividend income. Hi, my name is Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. In this wide-ranging interview, we cover dividend investing, dividend growth, and how to get started. Mark, welcome to the Simply Investing Dividend Podcast.
Thanks very much for having me. It's nice to chat again.
Yeah, it's great to have you on our podcast today. Mark, for our audience, why don't you tell us a little bit about your background first, and then how you got started with dividend investing?
Yeah, for sure. So, I probably started my DIY investing journey the better part of 20 some years ago, to be honest. I didn't always have My Own Advisor blog. It was kind of born out of a bit of a labor of love in terms of seeing how other DIY investors were investing, whether that was individual stocks or the wave of low cost ETFs which was coming into vogue at the time. This is running My Own Advisor blog is a bit of a hobby project. I have a full-time job. I like to do things when I'm not working or blogging. So golfing and travel and craft beer and a whole whack of other things, cycling and the like. So, my list of things to do is quite long, but I do enjoy the personal finance and investing front, and I wouldn't have met people like you if I wasn't doing what I do for the most part. So,
yeah, so that's great. I mean, so you've been doing this for a long time. Is it safe to say is it 20 years or more, right?
Yeah, I mean, I've had the blog almost for 15 years now, but I've been a passionate DIY investor for longer than that. You might go there, but when we talked just before the show here a little bit, you kind of hinted at why My Own Advisor and why start the blog, and why would you even think about putting some of your life online? And I kind of distill it down to a couple things. One is I wanted to make myself a little bit more accountable for my own investing decisions. So I basically use the blog as really an online journal or diary to say what I'm investing in and what not, and what's working and what isn't. I also kind of wanted to start the website just because I feel it's a way to connect like you with other like-minded people. It's an opportunity also to pay it forward in terms of my own mistakes or, my own shortcomings in terms of what didn't work and what I'm trying to do better. But ultimately, I am trying to advocate, and hopefully this comes through the site, that people can do this, right? This isn't something that you can't learn. It's not something that you can't take more control over. Money management fees paid to other people matter big time. Understanding your taxation matters big time. And so I think just having the confidence to know that you can do this, even if you don't invest exactly the same way I do or you do, the fact is, and the reality is a lot of people can take more control over their financial affairs, to be honest.
Yeah, absolutely. And I agree with what you said. I mean, cost is a huge thing. If we take a look at, I've got an example here. I want to make sure I get the numbers right. Just even a 1% MER. So that's for those of you who are new to the podcast, that's going to be the management expense ratio. So even a 1%, if you've got $500,000 invested, after 20 years, you're looking at almost $400,000 lost to fees. So that's incredible.
It's a phenomenal amount of money, and no person in their kind of sane mind would ever want to light a match and put some kerosene with $400,000, right? So fees matter, knowledge matters, and I think Morgan Housel kind of said it best in The Psychology of Money, a very well written book for your audience, Kenwal, if folks want to pick that up, but. he basically said, you don't have to be a perfect investor. You just have to, limit your mistakes and do more things, do the good things a little bit more often than some of the bad things. And that's really what it boils down to, is just being a little bit more good and bad, and trying to make sure that, you are watching where your money goes and where you value it most.
Yeah, I like that. I like that quote. That's so super important. You don't need to be a rocket science to do this. And I tell people you don't need advanced degrees in finance or accounting to be able to do this yourself. So, Mark, what attracted you to the do-it-yourself approach? Because most Canadians, I'm going to take a guess here, and say majority of Canadians don't do it themselves when it comes to personal finance or investing, and they just leave it to the experts. So what made you go to the do-it-yourself approach?
Yeah, I mean, I think for me, the trigger was before the great financial crisis, long before that. I think it was really coming out of the late 90s and the tech boom, that kind of era where, I was already invested in some big bank mutual funds at the time, and the tech crash happened, and I didn't invest in pets.com or all these other things, but, I had enough money in tech where, it did cause some alarm for concern, right? And I sat back and I thought about this, and I'm like, okay, well, where is my money going? Like, where is this MER that you spoke of? Where are these fees going? Are there trading costs that I don't know about? I looked at the fund profile, and I was supposed to be in a low to medium risk fund, yet I'm losing thousands of dollars at the time during this tech crash. And I just started thinking, like, none of this makes sense to me. Like, how can I be being advised, but I'm not being contacted? Or I'm investing in a fund that's medium to low risk, but I'm losing lots of money. And so none of these things added up to my head. So I really took it upon myself to start learning a little bit more about stocks, a little bit more about individual stocks. Again, ETFs weren't as ubiquitous as they are now, in terms of having, almost just as many ETFs on the market as there are mutual funds, maybe, or at least approaching that. But, I really started to take a deeper dive into, what is the potential best way to invest my money that also meets my behavioral profile, right? And I'm sure we'll talk about that, where there is a psychological benefit of dividends and seeing the income come into your account, and it's not all about high yield and so on and so forth. But, at the end of the day, I started to realize, like, wow, there's got to be a much better way to invest than these high price mutual funds that don't have my value system in mind. I'm probably paying way too much, and I'm not actually understanding the structure or the risk profile. And so that's really the genesis of my DIY investing journey. And the blog was born more out of a passion to better chronicle what I'm doing and why I'm doing it. So that's why I started. I read very early blogs in the early 2000s, $1 Million Journey, one of my friends and partners from one of my other sites. He was probably one of the first people that had kind of a bona fide blog, if you will, that was well read and well followed. And so he and I talked quite a bit. And there was also, new sites and forums like Canadian Money Saver that's still in existence, and a few other publications as well, Canadian Money Saver, to name a few. So, these were all great resources that made a lot of sense, not only because they were knowledge bases for people like me striving to understand DIY investing, but it's something I could learn in my own terms and take my own time with. And it's not like I had to upend the whole apple cart in the portfolio all at once. I could take my time over a period of many months or, a year or so, and really start understanding how and what I'm investing in, and is there value there for me as an investor.
Yeah, that's great. It's a bit of a journey. It was the same thing for me. It wasn't something that happened overnight, and it was a journey of educating myself first, right? What's going to work, what's not, what are the costs, how do the MERs, when they add up, how does that impact my investments? So in your case, so you started looking towards a DIY approach. How did you end up with, I know you do individual stocks and you do ETFs, right, as well. How did you end up in the dividend space? And not,
great.
You talk to everyone else, everybody's talking about high growth stocks, and nowadays it's crypto and EV stocks. How did you end up in the dividend space?
Yeah, I think it comes down to a couple key things. One is I like getting paid. So certainly from an ETF perspective, right? So, and I've said this on various podcasts, my own site, you and I have talked about it too, when we meet is, dividends and capital gains, they're kind of like two sides of the same coin in some respects, right? So ideally investors want lots of dividends, right? Lots of income. And they probably want lots of capital gains too, but it's hard to get both of them at the same time, right? So you kind of have to have trade-offs. And folks that follow your site and the podcasts and the newsletter and such, they would know that, there's a balancing act, right? In terms of getting income today or distributions from an ETF today, but also the hope of capital gains over time. But to be honest, back to your question, the notion of getting paid to be an investor, to see the actual money flow into my bank account or our bank account for that matter, was extremely appealing to me. And it's maintained the kind of the psychological but motivating factor of why I invest the way I do. It's not that I'm not against the total return. I certainly have stocks that are yielding next to nothing in my portfolio, right? 1%, 1.5%. But they tend to grow their dividends by quite a bit because they can, offer that type of shareholder return to shareholders. And it's probably worth noting too that from a dividend income, dividend investing perspective, dividend growth perspective, that's just it's one outcome of a much deeper set of factors or values, right, that the company has. So the company has profitability, it may have momentum, it may have, a moaty existence, right, a competitive advantage. And so there's all these other factors that go into why a particular company or sets of companies or set of sectors may or may not perform well. But dividends tend to be the byproduct of a company performing well because you really can't fake them for long, right? You can't return money to shareholders and you can't fake that payback process unless you have the revenues and the earnings to do so. So I kind of like that aspect, right? From a company's perspective is that sure, companies can offer share buybacks and companies can also pay down debt. Awesome, personal and for companies. Companies can grow by acquisitions. We see that in the tech sector quite a bit. But dividends just happen to be another way to return shareholder value. And it appeals to me for the large principle of getting paid and being motivated by increasing income over time.
Yeah, I like your answer. The first thing you said was, I like getting paid. And that's great because you want to get paid for owning those shares. And for me, the dividends also provide consistency, right? I've been doing this for 23 years. Also probably started around the same time. I remember the tech bubble. I invested in Nortel not once, but 3 times as the price was going up and then it was coming down. I was buying more. I learned a lot from that. So dividends provide consistency, especially in 2008, 2009, we saw the financial crisis. Most recently, March of 2020 with COVID, in March, the markets tanked. But, so the value of my portfolio has gone up and down over the years. But I can tell you and tell the audience that in the last 23 years, my dividend income has gone up every single year.
Yes, so has mine. I've been very fortunate. Now, mind you, I've also invested new capital, but thanks to the dividends being paid, thanks to those dividends being reinvested, i.e. you're taking a bit of a total return approach. You're not taking the income as cash and, deploying it in new companies. You're reinvesting it in the same company. So you're kind of taking that total return approach, right? And coupled with the fact that the dividends tend to be increasing from time to time, right? So said companies, some that you own, some that I own, they have a dividend policy of sometimes not only increasing them once a year, but twice a year, depending on the board of directors' decision. So you add all those factors in and that income pile tends to grow over time. So eventually your portfolio is working for you. It doesn't necessarily start off that way. It seems like it's going to take forever. And you look at all these other DIY investors or people that are older than you and you go, oh my goodness, how did you get there? But it's disciplined savings rate, it's time invested, and then the compounding just takes on a life of its own after a while. So those are things I think for your audience to really keep in mind is everybody, like anything in life, you have to start somewhere. And whether you take a dividend investing approach or a more holistic, low-cost ETF total return approach and do your own self-made dividends, I don't think either approach is incorrect. It's whatever you feel you need to meet your own objectives that's aligned with your values and kind of your behavior. But it does take time, and with enough incubation time, the money will absolutely grow. It's just it's phenomenal when you start actually seeing it in real time.
Yeah, and that's what I tell folks is you need two things to be successful here as an investor, DIY, is you need time and money. So the more time you have, the better off you're going to be. And the more money you have, the more you can invest and get more in dividends. If you've got both, fantastic.
Yeah, that is ideal. And I know for a lot of folks just starting out or maybe new to investing, it's daunting, right? I've been there. And personal finance investing is a huge body of knowledge. It can be overwhelming, but to your earlier points, I think a little bit of reading, certainly a little bit of self-reflection, and ask a lot of questions, and ask difficult questions. Why this company over that company? Why that particular fund over this fund? What happens if the dividend may get cut? Is that going to affect my behavior, how I invest? What happens if the stock goes down 20, 30, 40%? So, going through some thought exercises and the like will make you a wiser investor and hopefully make you a better investor. But I can appreciate it's daunting. But once you get the ropes, once you understand thyself a little bit more and how you want to invest and how you can stick to a long-term plan, time and your savings rate will do wonders.
Yep, absolutely. And I like what you're touching on here is a little bit on investor behavior, because let me give you a scenario. So if somebody buys a stock, whether it's a dividend or a non-dividend stock, you buy it for $30. Tomorrow it drops to 25, and now you can't sleep for the rest of the week because you're stressed out about this. Is that somebody who should be investing, or what should they be doing? What kind of personality or characteristics do you need to be a good, successful investor?
Yeah, I mean, it's a tricky question because we're all built a little bit differently. We're all wired a little bit differently. So some people can, I would say, delay gratification maybe better than others, and that doesn't make it right or wrong. It just means you need to understand thyself a little bit. But when we think about the traits of dividend investing, dividend growth investing, or just individual stock investing in general, the fact that some companies tend to reward shareholders through dividends or distributions, I can tell you from personal experience, it does help me psychologically, because whether the stock goes down by $5 or $8 or $7.50, as long as my guiding principles about why I've owned this company or why I decided to buy the company in the first place don't change, it doesn't really bother me. There are stocks in my portfolio that are, down 5%, 10% at times, sometimes 15%. But then there are other stocks, thanks to kind of riding out those waves, where even in the last 5-year returns, they're up 80%, 90%. So, it does take a certain temperament to be a long-term investor, period. But I think the benefit of dividend investing, or at least some income-oriented investing, is you still can get some diversification. You can still have your assets grow through capital appreciation without selling the assets. Again, it's easy to understand in that the company makes a profit. Some of the earnings are paid out to you as a shareholder. And it honestly reinforces a bit of a buy and hold, and knowing that you're going to get paid. You can have a little bit of comfort and that stability that you spoke of, that you got paid last quarter, you should get paid next quarter. You may get paid something higher next year. So these are the types of, I would say, psychological buy and hold benefits, or buy and hold some more benefits that dividend investing offers, that may be appealing to some investors. Again, it's not like you have to invest this way. There are absolutely other ways to invest. But these are some of the benefits that come along with this style of investing. And I think they're value added for many people for many reasons.
Yeah. And I think I know for myself, seeing the dividend coming in, because I track everything, so I'm tracking when the dividends are coming in, it gives me a sense of confidence that, okay, I got the dividends. I've been getting them for many, many years. They're going to continue to come in. And I'm not so much stressed out when I see the stock prices drop. Right? I can feel a little bit more confident that, hey, at least I'm getting some income coming in.
Yeah, I mean, the best way I could summarize it and phrase it before we move on a little bit is dividends provide some level of optionality, right? So you can choose to reinvest the dividends or your distributions from different companies, real estate investment trusts, what have you. You can decide to take the money and spend it on other assets or pay down debt as you please, or do things. Or you can just let the cash accumulate, right? So dividends offer you a bit of this optionality, whereas a total return approach, you're more on the side of, I won't necessarily say hoping for capital gains, but that's where a lot of your focus is capital and price appreciation. It's not about necessarily getting paid today. And like I say, there's trade-offs. But just because a company pays a dividend doesn't mean it's a good company. And just because it pays a high dividend or a low dividend doesn't mean it's necessarily right for your portfolio. So there's a lot of considerations in terms of how you build your portfolio, what you invest in, why you may want to invest in certain companies. And that's very unique and individual to the DIY investor.
Yeah, absolutely. Now, what do you say to people who will tell you, and they're not wrong, the dividend is not, the company has no legal obligation to pay you a dividend. So companies can reduce the dividend anytime they want. They can eliminate it anytime they want. And we saw that in March of 2020. Disney, Boeing, General Motors.
Right.
They just cut the dividend. So how do you have any confidence to keep doing what you have been doing for the last 20 years? Right? When the dividend, there's no guarantee of a dividend in the future.
Yeah. So the way I look at that, Canwell, is I'm not just buying one company, right? So, when you look at a low cost ETF, let's take even XIU, one of my favorites in Canada, right? It owns the top 60 companies in Canada, the bluest of blue chips, if you will. So, I'm not saying, and I'm not advocating that any one investor would need to have 60 holdings in their portfolio. But the reality is if you're owning different companies, individual companies in different sectors, potentially even in different countries, i.e. from Canada, US, international, what have you, if one company just decides to freeze their dividend, chop their dividend, suspend their dividend reinvestment plan, any kind of flavor of those things, it's not going to be catastrophic to your income stream, and it's also not going to be detrimental to your income growth story. It happens to be one company out of hopefully, let's say, a couple dozen, if you will, that's a bit of a hit. That is absolutely an individual stock risk. It's happened to me before. It may have been happened to you, I don't know, but it's happened to other investors, I'm sure. And that is one of the rubs of the green, if you will, in terms of individual stock risk, is as sound as the company may have been historically. I always say the future is very financially cloudy. I can't predict what's going to happen in a month or in a quarter or a year. The chances that said dividend paying company will continue to pay their dividends, maybe that's very good. But at the end of the day, you are investing in an individual company where that long-term viability of the company could be uncertain. So that's where diversification, if you're going to be a DIY stock investor, is very important, not only in different companies, but different companies in different sectors and potentially different countries. And that's part of the hedging risk that I use. While I'm on the theme, I try to have basically a 5% rule. So one of my rules and kind of my tenets and one of my kind of thinking is I don't want to have any one company in more than 5% of my weighting or my portfolio. And that's going to reduce my individual stock risk. So even if a company went to absolute zero, forget that the fact that they stopped paying a dividend, that's neither here nor there. But if they went right to flat out zero, conceivably, realistically, I have 95% of my portfolio intact, whether that's a growth portfolio, a low cost ETF, or what have you. So I tend to sleep very well at night using some of those kind of rules of thumb for me. But but it is a concern. And I think as individual stock investors, you need to understand the diversification risk and also the individual stock risk. If you're going to kind of go all in on a certain company or a certain sector.
So then, Mark, do you rebalance your portfolio once a year or twice a year? What's the frequency when you would take a look at it?
That's a great question. I think what I use is I kind of use some low cost ETFs like XIU and a few others as a bit of a proxy. Like right now, what Canadian financials are 30%-ish. Energy is probably a little bit higher than it historically is. It's probably around 15-20% maybe now. So I kind of use that as a bit of a guideline, but honestly, I determine my own sector weights. If I find the Canadian broad market has only 5 or 6% in telcos, I may decide to own more. I may decide to own more utilities. I may be more particularly bullish on materials or infrastructure stocks. And so I determine my own weights, but I kind of use, XIU and a few other low cost ETFs as a bit of a proxy. And I add to your question about rebalancing. I basically I rebalance by adding new money where I can. So I don't actually sell anything. I try to save up money, whether it's my TFSA first every year or my RSP, and I try to rebalance my portfolio by basically adding new money, basically by hopefully where I can buying a lagging sector or a lagging stock. So years ago, industrials and some REITs and stuff were out of favor at the time. And then COVID hit and things tanked, but then certain REITs, certain companies came back and they were flying high. So that was an example where, I bought something that was lagging. It seemed to have value and it came back in vogue and my portfolio benefited from that. So those are the things I try to do, but I really don't do any active balancing other than basically buying where I can and when I have the money to do so.
That's a great approach. I like that. Instead of when most people think about rebalancing, they're thinking about, okay, I'm overweight in this sector. I'm just going to sell bring that back down again. And I like your approach is, well, I'm going to rebalance with new money that I'm going to be investing, because you don't want to be selling, especially if you're owning good quality stocks or even with ETFs and they're paying you dividends and they're growing the dividend. Why would you want to cut off your supply of dividend income from that investment by selling it?
Yeah, exactly. I mean, at times, even with my 5% kind of cap weighted rule, if you will, in my portfolio, some stocks get up to 5.5%, 6%, right? So it's like, okay, that's a warning sign, but that's also a good problem to have. And that air quote, some of my winners are running, but that's okay, right? I'm aware of it. I understand the risks. What goes up could go down. But fundamentally, I try to rebalance by basically adding new money. And I have maybe a similar complexity that maybe some of your audience and maybe you yourself have, in that I don't have bonds in my portfolio, right? I look at my future small pension at work. I look at CPP and OAS government benefits eventually as basically that fixed income, inflation protected, mind you, bond like money. So in my asset accumulation years, I've said a lot in my site, I'm not too fussed on owning bonds. I need to keep some cash for sure, because that allows me to deploy money when I want and buy those stocks when they're on sale per se. But I don't tend to have bonds, so I don't tend to have transaction costs when I sell the bonds, and I don't have to worry about rebalancing my equity to bond allocation. I just take the new money when I have it. New TFSA contribution room shows up, boom, money goes in. I buy what I feel I need for that year, and I get on with the rest of my life. So that's kind of how I go about things, and it seems to work really well for us.
Mm-hmm. Now, conventional wisdom tells us, and it's been ingrained in my head for years, is when you're younger, you want to invest in equities. And as you get older, sell off the equities and start moving towards fixed income. So bonds and GICs and term deposits. Are you going to be doing that as you get older, or do you have a different approach to when you hit the retirement age? Stay tuned next week for Mark's answer to my question. In part 2, we continue our discussion, and Mark talks about how he's investing in today's economic climate and what advice he would give to his younger self. So stay tuned next week for part 2 of my wide-ranging interview with Mark.